Yeah, yeah. So what did happen with SVB? So in 2020, after the Fed and the Treasury started distributing all these uh, cash to all the companies out there during COVID, we've seen a tremendous growth in terms of deposits that these companies had, and especially the one who benefited the most when rates were lower, and grow the most when interest rates are at zero is obviously tech, which is what SBV was focusing on. So SBV had a majority of its accounts and close to 90% of its deposits from fintech and tech companies, and the average deposits over there was fairly large. It was about $4 million average deposit from these type of institutions. So as you can see here, SIVB, which is the SVB bank, had the most growth in balance sheet. And so at some point, as their balance sheet bloated, they invested in mortgage-backed treasuries, securities, which are kind of a quasi U.S. treasuries, but on the mortgage side of things. Then what happened is that as the economy started heating up and the inflation started picking up, the Fed had to catch up. And in the last year, in 2022, we've seen the highest rate hikes we've seen in a very, very long time. They increased rates by about 400 to 500 basis points, so 4.5% to 5%. And obviously, we live in an economy that is very leveraged and has a high amount of debt. And so now we're starting to see the unintended consequences of what that means. So most bank will be, so it's a little different than 2008. 2008, the bank's balance sheet was full of those toxic mortgages, and they were not as prepared, and the regulator didn't have as many constraints on those on the banks, and so it was a very different crisis. In this case, it's nearly it's the world upside down, because like what these banks had was actually US treasuries, which is the best quality paper that you can have on your balance sheet. The problem is that when you buy these things at 1% and then the rates go to 5-6%, well, you create losses on your balance sheet even if you own these. So you have to make the distinction, and we'll come back to that, between medium-sized banks and large banks, because in 2008, after the crisis, Dodd-Frank and all that put some very constraint and restriction on large banks, which are sometimes called GSIB, which is global systematically important banks, and those have to show carte blanche to the regulators on a regular basis on a lot of different ratios. They have to have, don't want to go into too many details and whatnot, but like tier 1 capital ratios, LCR, which is going to be important in this case, which is the liquidity coverage ratio, which means that these banks, these very large banks, need to have 30 days of liquidity on hand at all time. And they have to show that to the regulator on a monthly basis. Same thing in Europe, that's on a quarterly basis. The problem is that, so the large banks are now more constrained and in a way safer. They're also much more diligent in the way that they function. So some of you might have heard that there's a lot of acronyms, so I apologize for that, but there's been a lot of talk about like AFS and HTM. AFS means security available for sale, and HTM is securities held to maturity. So those are basically when they buy those treasuries or those HQLA, high liquid quality assets, the banks put them off balance sheets into these two buckets. Most of the large banks are sophisticated enough and use derivative products and swaps to hedge that risk. So if they buy a treasury, which is a fixed coupon, they're going to basically pay a fixed coupon in swap and receive floating. So then they have a floating rate and a lot less interest rate risk. And they can hedge the AFS side of things and not so much the HTM side of things for accounting reason. And again, I'm not going to go into the details. Please feel free to hit me afterwards or anytime if you really want to go into that. So big banks are a little more secure because they have more constraints and they're much more sophisticated at hedging themselves. On the other side, the small and medium-sized banks, a lot of those constraints were taken out in 2018 and made them a little weaker. And so when they bought those securities, they didn't hedge well, and then they created massive losses in their portfolio. And that's what created the downfall of SVB, because people started worrying about that, and then all that cash that you see here that they got in 2020 and 21, in 2022, all the tech space collapsed, right? Because when rates go higher, the worst sector to be in is tech, and therefore they started drawing on all the liquidity they had at the banks. They started pulling the deposits. So they pulled so much deposits that SVB was forced to sell those security that was keeping off balance sheet, and now they created a loss. And then people started seeing the loss created, and the sophisticated account went in and started, it's been wildfire. And as I was saying before, in our little pod, nowadays with Twitter, with all the information in the world getting to everybody on their cell phone in a heartbeat, it's been a massive exit last Thursday. So to give you some perspective, SVB had 42 billion in one single day that people wanted to take out of that bank. Last time we had a run on the bank on the biggest bank in the world, which was Hajhamou Securities, that you see, that was a 307 billion bank, which was not a small bank, but that was during the financial crisis. It took 10 days and 16 billion of people taking 16 billion over 10 days to create that bank run. So you can see the sharp difference in the modern world we're living in, where things just go like wildfire. And so the Fed had to take over, the FDIC had to take over SVB last Thursday night. They put them into receivership, and then the next day, Signature Bank went out, and then thank God there was a weekend, and then the Fed and the regulators over the weekend, I think, did the right thing in coming in strong and guaranteeing the deposits from SVB and Signature Bank, because if not, Monday would have opened even more of a catastrophe. So it's not a bailout, a traditional bailout, if you will, because there's no taxpayer money that goes into this. It's mostly whatever is left at these banks, and then the FDIC has the FDIC is basically an insurance, and all the banks are forced to buy insurance from that. So a lot of the premium that are paid are put in a fund, and that fund is about 120 billion. So a lot of those deposits that were back are coming from that money, and not the taxpayers' money so far. So the other thing that the Fed did is they quickly put a new backstop facility in place for 25 billion, which means that what was happening, as I mentioned, the AFS and HTM, if you remember, available for sale and held to maturity book, which was holding all those, treasuries and AAA securities. In order to avoid people to be a forced seller, they said, okay, those bonds are trading at 80 cents on the dollar. You can come to the Fed at any time, give them to us as collateral, and then we'll give you $100 against that 80 cents. So usually it's the opposite. The Fed takes collateral, but always at a haircut. So if you give them something that's worth 80 cents, they will only give you 70 cents on the dollar. In this case, they said, no, okay, we'll take the 80 cents and we'll give you $1. And that's a loan for 1 year until things quiet down. So that helps. And I think it was a good thing to do. But it's only a $25 billion fund so far. and let's hope that things don't get don't get worse. And how can they get worse is that, well, we have 5,500 billion in all the small and medium-sized bank in the United States. So if all that money was moving at the same time to the GC bank, the Bank of America, Chase, and whatnot, it would be problematic. So at this point, I think that we're seeing it. Those small and medium-sized banks are having issues, and seeing deposits moving away from them. Yesterday, the Bank of America announced that they received about 15 billion from various players out there. The federal home loan system, which is also kind of the Fed of the small and medium-sized bank. It's not a government entity, it's a private entity, but it's like a cooperative. Has also raised 250 billion to kind of help and come to the rescue of those small and medium-sized banks. And so at this point, I'm going to stop and see if you guys have questions, and then I'll go into what are the consequences of all these things. But I think, the conclusion for you guys is, definitely if you have uninsured deposits, meaning deposits that are above $250,000 at any of those small banks, check how is that small bank, how is the balance sheet of that small bank. You can look at their 10K, you can look at, bank analysts and try to understand what's their portfolio, what's the losses they have here. There's an example of the, the losses that those banks have in their mark-to-market portfolios, and then try to move away the money that is uninsured, right, for your safety. And I think that's what's happening right now. You see a lot of people moving anything above $250,000. There's also some new banks like Mercury or Brex, which are not banks, they're technology companies in a way that guarantee, up to $2 million. And so people are like, how can they guarantee me $2 million in FDIC money? Well, what they do is that they take your pool of money, and then you have one account with them, but then they split it to a multiple blank. So if you had $1 million, they would split it 4 times into FDIC insured banks out there for you, so your money is a little protected. So some people have used that. They use what we call I think it's called the sci-fi network, that's been created over the last few years. It's fairly new banks, but or technologies, and then the other ones are just going to move it around to probably the JP Morgan, the Chase, and whatnot, and we're seeing it as we speak. The consequence for that is that, because small banks deposits, they make loans to people, and so the less deposits they have, the less loans they're going to be able to make. I mean, I don't know about you, but for my real estate stuff, most of the time I get the better terms and loans from the regional banks and the local banks, and the credit unions more than the Chase and the JP Morgans. And so that's probably going to tighten a little more. It was already tightening, obviously, after the Fed started raising rates last year. And some people started slowly getting a little bit in trouble in some of the multifamily, for example, where some capital calls were coming, and anybody who bought 2.5 to 4.5 cap rates are feeling the heat right now. And so a lot of these banks had started reducing the loans that they're making, and now I think it's going to impact them even more in reducing. So that means that less growth, less loans, and therefore less growth, and probably more complicated for small businesses and real estate.